If you have ever deposited $10,000 or more in cash at any bank in America, a federal report with your name, your social security number, and the exact amount is sitting in a government database right now, and the bank never told you, but that is only the first of 5 rules quietly freezing senior accounts across this country. The most dangerous one does not even require $10,000. It requires just over $5,000, and something the bank alone decides looks suspicious. Here is what every senior needs to know before they walk into a branch again. Rule 1. The currency. Transaction report. The Bank Secrecy Act was passed in 1970. The $10,000 trigger has not moved in 56 years. In 1970, $10,000 was a down payment on a house. Today it barely buys a used car. Every year that threshold stays frozen, more ordinary retirees get pulled into a federal reporting system originally designed for drug cartels. Here is how it works. Anytime you deposit or withdraw $10,000 or more in physical cash in a single day, the bank is required by federal law to file a currency transaction report with the Financial Crimes Enforcement Network. It includes your full name, social security number, date of birth, account number, and the exact amount. The bank does not have to tell you they filed it. In most cases, they do not. The IRS can cross-reference it against your tax return. The FBI can use it to build a profile on you before any crime has even been suspected. And this applies to withdrawals too, not just deposits. Cash a treasury bond for $11,000, close a safe deposit box with $15,000 inside, withdraw cash to buy a used vehicle from a private seller. All of it triggers a report on you. Rule 2. Structuring. The accidental felony here is where it gets dangerous. Most people think the safe move is to split large cash deposits into smaller amounts to stay under $10,000. That instinct is a federal crime. It is called structuring, defined under Title 31 of the United States Code. The penalty is up to 5 years in federal prison, a $250,000 fine, and civil forfeiture of the funds involved, and you do not need to be hiding criminal money to be charged. You only need to have split a deposit to avoid the reporting threshold. Carol Hinders ran her restaurant for nearly 40 years. She deposited daily cash receipts always under $10,000, because that was simply what her business took in each day. The IRS seized her entire $33,000 bank account without filing a single criminal charge. She fought for 18 months to get her own money back. Randy Sowers ran a dairy farm in Maryland for over 30 years. The IRS seized $63,000 from his operating account. No crime, no charges. A 2-year legal battle and significant media attention to get most of it returned. The safer move is the exact opposite of what most people assume. If you are moving more than $10,000 in cash, deposit the full amount at once. Answer the banker's questions. Let the report be filed. A currency transaction report on a clean source creates a paper trail that protects you. A structuring charge on the same money can cost you the funds and 5 years of your life. Rule 3. The Suspicious Activity Report. This is the rule that caught 74-year-old Harold from Ohio. And unlike the $10,000 threshold, this one has no fixed trigger amount at all. Banks file over 4 million suspicious activity reports every year. The software scans every transaction for patterns that deviate from your normal behavior. Deposit slightly more than usual, flagged. Wire money to a new account, flagged. Withdraw larger amounts before a family event, flagged. And when it fires, the bank is legally prohibited from telling you. A banker can lose their job and face personal fines just for disclosing it. Harold had been with the same community bank for 31 years. When his wife of 52 years passed away, the life insurance paid out $85,000. He deposited the check. The compliance software flagged it because it had never seen a deposit that size on his account. 2 weeks later, he tried to transfer $15,000 to help his granddaughter with college tuition. The transfer was blocked. His account was frozen. No explanation. 2 automatic bill payments bounced. His Medicare supplement coverage lapsed for 19 days. When the freeze finally lifted 93 days later, no apology, no explanation, just reactivated. The freeze does not just block your account. Your automatic mortgage payment fails. Your insurance premiums stop processing. Your prescription refills bounce. The bank's compliance department operates on a completely separate track from customer service, and compliance officers do not take calls from customers. The protection move is to get ahead of it. If you know a large deposit is coming, life insurance payout, an inheritance, a home sale, walk into the branch before the money arrives. Tell a personal banker exactly what is coming and why. They cannot stop the software from flagging it. But a documented conversation in your file gives the compliance officer a reason to clear it in 3 days instead of 90. Rule 4. Retirement account triggers. This one specifically targets seniors, and almost everyone over 65 is exposed. When a retirement account distribution check is cut to you personally, even if you plan to roll it into another account within 60 days, the bank sees an incoming deposit that does not match your normal pattern. If the amount crosses an internal threshold, a suspicious activity report can be filed. If you then move the funds out quickly to complete the rollover, a second report can be filed on the outgoing side. 2 reports on the same dollar. And you never know it happened. Required minimum distributions trigger the same problem. A single annual RMD payment of $42,000 landing in a checking account that normally sees $2,000 a month looks like an anomaly to the software, even though you are legally required to take it. For widows and widowers, the exposure is even greater. Life insurance payouts, spousal inherited IRA distributions, pension survivor benefits, and joint account reassignments all tend to hit during the same narrow window after a spouse's death. Banks call this the grief window, statistically the period when more senior accounts are frozen than at any other point in life. The same protection applies. Before any large distribution arrives, walk into the branch and document the source and the intent in your relationship file. What takes 90 days without that conversation can take 3 days with it. Rule 5. Beneficial ownership. Reporting. This is the newest rule, and most seniors who own any kind of small entity have never heard of it. The Corporate Transparency Act required every LLC, family limited partnership, and trust with a business account to report their beneficial owners to the federal government. A federal court struck down the federal requirement in early 2026, but states immediately started filling the gap. New York's LLC Transparency Act took effect January 1st of this year. California, Massachusetts, Pennsylvania, and Illinois have introduced or passed similar legislation. Illinois enacted its version with a grace period that expires this summer. If you own a family LLC holding a vacation cabin, a rental duplex, a small farm organized as a limited liability entity, or a consulting practice run as a pass-through company, you may now be required to file beneficial ownership disclosures at the state level. Missing the deadline can trigger administrative dissolution of the entity, and when the entity dissolves, every asset it was protecting walks back into your personal exposure. The seniors who get hurt by these rules are not criminals. They are ordinary people who simply did not know the rules existed until it was too late. Now you know. Take the 5 steps this week before the software flags something you never saw coming. If this video protected you or someone you know, hit that like button and share it. This is the kind of information that needs to reach more people before it becomes their problem. Subscribe to the channel and turn on notifications so you never miss the videos that could protect everything you have spent a lifetime building.